Okay, let's unpack this. We're diving deep into a source a listener shared, and it's all about using technical indicators to uh, try and spot momentum in the market.
That's right.
Think of this as like a guide to understanding one specific strategy. The source claims it can help find those, potentially big trending moves.
And just as importantly, maybe help you know when to stay out. Avoid that choppy sideways stuff.
Exactly. All based only on what's in this source material, which is a video explaining the strategy.
Yep. And remember, technical indicators, they're just tools, right? Ways to slice and dice price and volume data, looking for pattern signals.
Mm-hmm.
This source focuses on two very specific ones, designed according to them to gauge market momentum. We're just going to stick strictly to their methods, their rules, as presented.
Absolutely. We're just navigating their map for you. So the first tool they bring up in this video source is called the CDV indicator.
Right. CDV stands for Cumulative Delta Volume RSI at candles. Bit of a mouthful.
It is. And visually, the source shows it having, well, a main line.
Yep, a line. And then this thing called an MA baseline. That's the one that actually changes color flips between blue and red.
Okay. And they also mention sometimes you see yellow candles appearing right on the price chart.
That's right. Yellow candles pop up occasionally. We'll get to what those mean according to the source.
Got it.
Yeah.
And the setup seems quite particular. The video stresses you have to uncheck Heikin-Ashi candles.
Yeah, that's step one, uncheck Heikin-Ashi. Then for the SSL1 baseline, type should be HMA, length 88.
HMA 88.
And SSL2 length is set to 5. The main CDV line itself, they style it blue.
Sure.
And that MA baseline, the color-changing one, that uses the blue and red. Those are the key colors you're watching.
So the interpretation, basically, from the source, it hinges on that MA baseline color change. Blue means one thing, red means another.
That's the core idea they present for the signal, yes. Blue or red gives you a directional bias.
And those yellow candles you mentioned.
Ah, yes. The source is very explicit. Yellow candles mean a sideways market. Choppy conditions. And according to this strategy, you ignore them completely. No trades if you see yellow candles.
Right. Filter them out. Now, the CDV also had something about ATR bands.
It did, yeah. They mention using ATR bands. The settings given in the source are period 14, multiplier 0.8, and smoothing is WMA.
And the point of those? Stop losses.
Exactly. The source suggests using them for setting your stop loss. You'd place it, they say, at the last curve of the ATR band below your entry for a long or above for a short.
Okay. Though they sometimes took them off the chart in the examples for clarity.
Yeah, sometimes they remove them just to, clean up the chart visually, but they definitely explain that stop loss function, so the idea is there even if the bands aren't always displayed.
Makes sense. Okay, so that's the CDD. What's the second indicator? You said it was pretty critical for this strategy.
This one's really important according to the source. It's the DMBI. Or, when they search for it in the platform shown, they just type DMI.
DMI. Okay. And what does that look like on the chart as they set it up?
So it has three main lines you watch. There's the DI plus line, which they color green. There's the DI line, colored orange. And then there's the ADX line, and they make that one red.
Green, orange, red. Got it. Specific settings for this one, too.
Yep. ADX smoothing is 14. DI length is also 14. And again, the styling helps. ADX red, DI plus green, DI orange. Makes it easier to read quickly.
So the DI plus and DI lines, they tell you about the trend direction. Like green above orange is bullish.
That's the basic idea presented, yeah. DI plus green above DI orange suggests bullish direction. And the opposite, DI orange above DI plus green, suggests bearish.
Okay, but you said this was really vital. What's the main job of this DMI, especially that red ADX line in this strategy?
Right. Here's the absolute key, according to the source. The red ADX line is their momentum gauge. It's supposed to tell you if there's actually strength behind any potential move. Is there momentum or isn't there?
So it's a filter. How does that work? What levels are important?
This is crucial. The source states very, very clearly, if the ADX value is below 20.
Below 20.
Yes. And they show examples, ADX at 19, 18, down 15. That means low momentum. Or no real momentum. Sideways chop likely.
And the rule is?
The rule from the source is, you ignore potential trades if ADX is below 20. Period. Doesn't matter what the CDV or the DI lines are doing. Below 20 ADX means no trade for this strategy.
Okay, that's a hard filter. So what about above 20?
Above 20, the source considers momentum to be present. Now it's potentially game on if the other rules line up.
Right.
They also add a little note of caution, though. If the ADX gets really high, like up near or above 50,
Uh-huh.
they observe that the momentum often has less chance of, like, sticking. It might be getting exhausted. So ADX around 50 could be a sign momentum is fading, maybe time to think about exits if you're already in a trade.
Interesting nuance there. Okay, so
Yeah.
we've got the CDD with its color signal and the DMI, specifically that ADX line, acting as a momentum gatekeeper above 20. And the core strategy presented in the source is really about using both together, following a strict set of rules.
Precisely. They lay out 4 specific rules. All 4 must be met to identify what they consider a high probability momentum setup, and it's just as much about filtering out those low momentum periods.
What about time frames? Do they specify?
Most of the examples in the source video were on the 5-minute chart, but they did suggest, you should backtest it on 15 or 30 minutes too, see what works.
And instruments. What can you trade this on according to them?
They mentioned it being used on things like Nifty, Bank Nifty, FINIFTY. Those are Indian indices, I believe. But they also said it could be applied to pretty much any index, commodity, or even cryptocurrency.
So flexible on what you trade, but very rigid on how you trade it with these rules.
That's the impression, yes.
Okay, let's get into those 4 rules then. Rule number 1.
Rule 1 is simple. It's just about the CDV MA baseline color. For a bullish trade looking to buy, that line must be blue.
Must be blue.
For a bearish trade looking to sell, it must be red. That's the first check.
Okay. Rule number 2.
Rule 2 involves the candle itself, its position, and its type relative to that CDV line. For bullish, a bullish candle has to close above the blue MA baseline.
Above the blue line.
For bearish, a bearish candle must close below the red MA baseline.
Below the rebel.
And importantly, the source stresses it needs to be a good candle, a solid bullish or bearish candle, not like a doji or a shooting star. Those kinds of ejection or indecision candles should be ignored, even if they close in the right place.
So the type of candle matters too. And what about those yellow CDV candles?
Right. Rule 2 also reminds you, if the candle itself is one of those yellow CDV candles, ignore the setup. That still means sideways, no trade.
Got it. Rule number 3.
Rule 3 brings in the DMI direction. It uses that crossover. For a bullish trade, the DI plus green line must be above the DI orange line.
Green above orange for longs.
Yeah. And for a bearish trade, the DI orange line must be above the DI plus green line.
Orange above green for shorts. Okay, aligns the direction. And then the big one, rule number 4.
Rule 4, the one they really emphasize, the ADX momentum check. That red ADX line's value must be above 20.
Must be above 20. No exceptions.
No exceptions according to the source. They show examples where rules 1, 2, and 3 might look good, but if the ADX is, say, 12 or 16, you skip the trade. The momentum just isn't there for this strategy.
Right. That's the filter doing its job. And remember that point about ADX near 50, possibly meaning slowing momentum.
Exactly. Keep that in the back of your mind for potential exit timing, maybe.
Okay, so those are the 4 rules.
What?
How did the source show this working in practice?
Well, they showed examples where, everything lined up perfectly, all 4 rules checked out, ADX was nicely above 20, maybe 25, 30, and these setups, they presented them as leading to successful trades that caught some decent moves pretty quickly.
Attributing that success to waiting for that momentum confirmation.
That's the narrative, yes. Trading only when momentum was confirmed by their rules.
And did they show examples of when not to trade?
Oh yeah, definitely. They showed setups where maybe the CDV was the wrong color, or the candle closed in the wrong place, or it was a rejection candle.
Or the ADX was below 20.
Especially that one. Lots of examples where the ADX was too low.
Oh.
And the instruction was clear. Ignore it. Even if maybe the market did happen to move in that direction afterwards.
Doesn't matter.
Doesn't matter for this strategy. The source's approach is you stick to the rules rigidly. If the high momentum signal isn't there by their definition, you wait. You sit on your hands.
Patience seems key. What about managing the trade once you're in? Stops and targets.
For stop losses, they mentioned 2 possibilities. Either place it just below the low of the signal candle for a long or above the high for a short.
Okay.
Or if you have those ATR bands enabled, place the stop at the last curve of the band.
And targets. What are you aiming for?
Ideally, they suggested aiming for a 1-to-2 risk-reward ratio. So if your stop loss represents, say, 10 points of risk, you're aiming for 20 points of profit.
Standard RR.
Pretty standard, yeah. Although they did show some examples in the video where trades went further, maybe 1.3 or more, but 1.2 was presented as the baseline goal.
Okay, so wrapping up the core message from this source, It really boils down to trading only when momentum is confirmed, specifically by that ADX being above 20 and all the other CDV and DMI rules line up perfectly.
That's absolutely the central theme. It's a momentum confirmation strategy defined by these very specific indicator readings and rules. Wait for the stars to align, basically.
And the biggest piece of advice, almost a warning that came from the source.
Backtesting. Cannot stress this enough based on the source. They were adamant. Always backtest the strategy yourself thoroughly on historical data before using real money.
Non-negotiable, it sounds like.
Absolutely presented that way. They make it clear results will vary, depending on what you trade, the time frame. Backtesting is the only way, they say, to see if this specific method might actually work for you and your trading.
So jumping straight into live trading without that homework.
Strongly advised against by the source's presenter. You need to do your own validation first.
Right. So there you have it, a look at the CDV and DMBI indicators, as configured and used in this specific source, combined into a strict four-rule system, all really centered around filtering for momentum using that ADX20 rule.
Understanding how they combine these indicators, these specific rules, it gives you a very structured lens to view the market through. Focus purely on their definition of momentum.
The goal, as they frame it, is to pinpoint those moments where momentum seems confirmed before you jump in.
And maybe just as valuable, to clearly identify when the market's likely flat or choppy the times, the strategy says you should just stay away entirely.
Seems like patience, waiting for that specific signal defined by their rules, is really fundamental to the approach described.
It really does.
Which leaves us with a final thought, perhaps. If identifying and confirming momentum, according to this specific method, is the key here, how might exploring other ways to measure momentum, maybe different indicators or even price action itself, impact an approach? Could combining different types of confirmation potentially strengthen or maybe even contradict signals like these? What else might be worth testing alongside this idea of waiting for the market to really show strong directional intent before committing? Something to think about.